Hello, my name is Craig Basinger, and I'm the Chief Investment Officer at Richardson GMP. And thank you for clicking on our macro update YouTube entitled The Final Quarter of a Rather Very Eventful Year. It's October 12th today, and the topics we just wanted to cover off in this short video are: one, a little bit update on the markets. The excitement clearly has continued as we rolled into September with a bit of a correction, and then also a big rebound following. A little update on the pandemic: 35 million cases plus one POTUS. For those who didn't watch enough West Wing when they were younger, POTUS is the President of the United States. But we are clearly in the second wave of this pandemic, and the markets continue to be relatively resilient to any case numbers. Finally, talk a little bit about the economic bounce and losing a little bit of its momentum. And this isn't too surprising, but it's certainly worth noting, how this transpires going forward from an economic momentum perspective. And then finally, how we're positioning within our recommended asset allocations, not just for the fourth quarter, but obviously beyond into 2021. And then finally, just cover off something we've written about before: is could a vaccine actually hurt the market? And not necessarily it's vaccine to be good for humanity, but based on the market's composition, may cause a rotation into value, which would be a pretty big headwind for the overall index numbers. So let's get started. This has been I've been active in this industry since the mid 90s, and by far this has been the year that has had the most activity and most eventful year that I've ever experienced. And clearly, even just from outside of the pandemic that has induced all of much of this, we've gone from an all-time high in markets to the fastest bear market, the fastest recovery. We've seen the biggest contraction in economic activity probably since a mass mobilization during wartime, followed by an abrupt rebound, unprecedented amounts of unemployment, and meanwhile we're still battling a pandemic. And it's clearly been just a massive year as far as trends, things changing, accelerating trends, decelerating trends, and just a changing environment. And as we sit here, we're clearly in what appears to be the second wave or third wave, depending on how you want to measure it and where. But we're clearly this pandemic is not relenting by any stretch, and we're sitting here also with about 10 million people not working in America and 1 million not working in Canada relative to the beginning of this year. So, and yet the equity markets, which have had a fabulous recovery, ran into a pretty big headwind at the beginning of September. It was an actual correction for the S&P 500. It dropped 10%. It doesn't feel like it for most people. It's rather a bit surreal from that perspective. I think in normal times, a 10% drawdown in the equity markets would have probably garnered more attention. But fortunately, it's also rebounded since then. And as we look at the futures this morning and the price action on Thanksgiving Monday, the American markets are obviously open. We're almost back to those previous levels. So it's a very resilient equity market, and it's even the bad news seems to come off pretty quickly. Meanwhile, the bond market has been extremely sleepy. This is these are U.S. and Canadian 10-year bond yields in the second panel of this chart, and as you can see, they've been relatively flat for much of the past 6 months. A lot of that is government buying, but it's also, I think, there's sort of this calm before a potential storm and where it's going, which direction it's going to move to next. Currency's been a little bit more active. Canadian dollar has been appreciating quite considerably. It had a bit of a pullback in September, but resumed its upward trend. Again, not sure how long this will last, but there does tend to be this sort of risk on activity when the equity markets are rising. The Canadian dollar also rises, and there's still more to come. That's the amazing thing. Like we have a U.S. election. We have Q3 earnings. Is there going to be more stimulus? Is there going to be less? These are still unknowns in the months ahead. So on the pandemic side, I'll be relatively quick. We're not experts on this area, but this is the number of active cases in the bottom panel here. We're clearly into a second wave as the numbers continue to increase. That's happening in Canada. I'm in Toronto. We've just gone back to phase 2. So there's been a number of closures. And I think different governments are responding in different ways to try and sort of combat this resurgence in cases in the fall months. One of the big positives, though, is mortality rates come down considerably. This is, there's a whole bunch of contributing factors to this. The age of the people contracting COVID-19 at this point appear to be younger, which helps. Society has become immensely better at treating it, whether it's drugs, some experimental drugs, access to ventilators, other tools that we've become much more attuned. There's also evidence that potentially the strain has mutated and become somewhat less lethal. So all certainly positive. And there's even evidence that wearing a face mask lowers the initial viral load, which helps reduce the mortality rate. But again, all positive. But there's still some pretty big unknowns. There is a vaccine coming. That is for sure, given that there's literally hundreds of companies working on it and in various stages of testing. How long, how well will it work? What's its efficacy is a big question. When will it be available is another big question. Most people are talking sort of Q1, Q2 next year. And will it be enough to get people to sort of get back to normal activities? So, this is the stringency index on the bottom right here. It's basically measures how stringent governments are being as far as, schools opening, borders opening, restaurants, and the like. And as you can see, China moves around quite a bit, but they're actually getting better and better. Now, keep in mind this scale on this chart just goes down to 40. It has to go all the way down to 0 to get back to more normal life. But again, it's kind of like 2 steps forward, 1 step back. I don't think we're going massive back to lockdowns anytime, unless the data really changed abruptly. That being said, it's not clearly a smooth path towards reopening. I think that's probably going to continue to impact the economic data and also the mentality of people. So switching to the economy, the bounce does continue, but it is losing a bit of its momentum. Like, there's no question this is, and in our market ethos that's coming out on October 12th, we talked about, or October 13th, we talked about the fact that this is not a normal recession. It has been very different. It's taken on a different life of its own because it's been self-induced, because it's hit services, because it's just a different kind of recession than we normally see. There's no excesses out there that need to be burnt off. It's more just demand in a whole bunch of parts of the economy were abruptly stopped. And this created obviously a global recession. Estimates now have global GDP coming down about 4%, and then rebounding about 5% into 2021. Again, those are estimates, so grain of salt on those. But clearly, we've come off the bottom. Q2 is likely the economic bottom, and now we're starting to see this bounce. And the question then becomes, what is the pace of that bounce and can it continue? Now, there's no question. This is a little bit more timely. So this is the New York Fed's weekly economic activity index for the U.S. It is a little bit more tilted towards manufacturing, but nonetheless, it has been improving. As you can see, it sort of troughed at about minus 11%. It's now sitting at minus 5%. This is a year-over-year number. When you see GDP numbers and they are quoted as minus 30%, which is happening sort of Q2-ish, keep in mind that's a quarter-over-quarter annualized, so it's not really a year-over-year number. It's been exaggerated, basically. And this probably gives you a better idea of exactly where the economy is from relative to last year. So again, improving steadily, coming back up. That's kind of what we want to see. But one of the things that's sort of slowing, and jobs are sort of key here. And normally jobs are a lagging indicator during recessions, but at this point, at this cycle, and this recession is different because it's hit services so hard. Labor has now become almost a coincidental indicator. So it's actually giving you a good idea of exactly what's happening on the ground. Now, this is the total number of employed people in America. And, so that's 150 million before the pandemic induced recession, obviously dropped down to 130 million and then started to rise again. Now, those increases in bars were pretty big in those first few months. But as you can probably see from that, they're starting to get slower and slower. And that's because, some of the jobs came back really quick. Other jobs are going to take a lot longer. And that's the problem now. And now we're starting to see layoffs in other industries. So there's a whole bunch of different moving factors here. Nonetheless, it does appear some of the momentum is starting to wane, which isn't too surprising. But again, worth keeping an eye on. Very similar chart. Looks in Canada, you just have to divide by 8 to get our total number of employment, but we are pretty much the same, albeit a little bit better, I think, because of the different programs that we've used to sort of keep more employees actually at their employer as opposed to going on direct government assistance. Now, there's been talk about this sort of K-shaped recovery, and I just want to share sort of what that is and what people are talking about. This seems to be the recession that everybody's throwing a letter at it, but they're talking K because, big drop off, but then there's parts of the economy doing really well. Other parts are doing terribly. So that's sort of the separation of the K. Part of it's recovering, part of it's going in the wrong direction. And you can see this in a whole bunch of different areas. Here's one. This is just gasoline. Gasoline demand is almost back to where it's 5-year demand level. It's 5-year average demand level at this point in time of the year, which is pretty impressive, considering a lot of people aren't going to work, but everybody's driving. People aren't taking mass transit, they're driving. People are, going on vacations where they can drive to. Nobody's flying, clearly. And again, this is sort of that K-shaped where, we employ a lot of people in the aviation and tourism industry. People aren't flying. Obviously, that's part of the lower K. But there are certainly parts that are winning. And durables, obviously, if you can't go to eat and you can't travel, and if you still have an income, people are sort of saving a lot more money than they have been in a long time. And that's encouraging people to go out and do some purchasing, especially on durables, homes, cars, PlayStation 5s, potentially RVs. And in fact, these bars are the total monthly spending of Americans. And as you can see, it sits at about 1.2 trillion a month before the pandemic. It started a little bit higher than that, maybe 1.225. And then it dropped down to about $1 trillion in the span of 2 months. And then it started to recover. However, and it's almost back up, it's sitting at about, $50 billion short on a monthly basis as far as spending relative to pre-pandemic levels. But it's where the money's being spent. And as you can see, that purple line, that's spending on durables indexed to February of 2020 versus the orange line, which is service spending, again, indexed to what it was at February 2020, February of this year. As you can see, we're actually spending more on durables than we were before the pandemic started. And that's because people are just buying items. And it's easier to buy those. You don't have to interact with as many people. So again, health concerns keep people active in those areas. Services, the other direction. The problem is we employ a lot more people in services. And that's a lot bigger component of the North American economy, Canada and the US. And if that spending, we need that spending to come back to sort of make this more sustainable. But it isn't. I mean, this is transit use year-over-year level. Again, hasn't come back, still sitting at about 40%. I mean, the one positive aspect is you can certainly get a seat on the subway, which is a positive. Finally, even eating out, the fact is you can see that people sitting down and eating came back substantially, but has sort of petered off in the following periods, more so in the UK. But again, obviously, with the new rules in Canada, we're probably going to move a little bit lower as well. So the key here is, you've got this K, you've got part of the economy doing really well, part of the economy doing really poorly, and that's the service-related areas. What we really need is, the economy kind of needs is continued government stimulus and support of that lower K until a vaccine does become available and we can get back to more normal activity. That's the crucial part, and that's why everybody is keenly focused on sort of what is the path of stimulus and support for different areas of the economy. So how are we positioned? I mean, from a market cycle perspective, things are getting better. There's no question. And even if it's losing a bit of momentum, still certainly positive. However, we're still a little bit underweight on the equity side and a little bit overweight on both, holding a little more cash and holding a little more alternatives, is it from a defensive and perspective. And the reason being is that, given how far this market recovery has come, we just think it's more prudent to take some off the table. There's a whole bunch of unknowns. Could it be a contested election? Could we see style rotation? I'll touch on in a second. Could there be other surprises out there? And given how far things have moved and where sort of earnings sit, we're just erring a little bit more on the side of caution. We have been reducing U.S. exposure. And again, this is the valuations in the U.S. market going back, to the 1990s. And it should not be lost on people that the valuations today are pretty similar to what they were in the late 90s. Not quite the same. I mean, dynamics are different and the earnings are suppressed because we're in a recession. But nonetheless, from a pure PE perspective, we are almost as expensive as we were during the tech bubble. I think that's certainly worth noting, especially when you look at international markets. The valuations are much more attractive. And again, that's, I think, certainly more potential upside in those markets at this point, especially if you want to look at it longer term. On the bond market, we're staying short duration bond. We're staying very boring. We do believe bond yields are going to move higher. This is the amount of, and this is pretty amazing. This is the amount of government Canada bonds and treasury bills that the Bank of Canada now owns. And the fact is, if you're ever wondering how are we paying for all of this, and the fact is the Bank of Canada is literally buying up the bond market and the new issuance market and supporting all these stimulus programs. Now, can this go on forever? The short answer is probably not. Long answer is we don't exactly know what the implications will be. That being said, we do believe some of the seeds of inflation have been planted. The fact is, though, for now, the deflationary pressures of the pandemic and the recession easily overwhelm those inflationary pressures. But down the road, we do believe it's coming. Yields will be moving higher, and that's why we're staying sort of short duration, more on the credit side. And it's also why we've sort of, instead of being defensive and buying more bonds, we've gone into alternatives such as real assets, bullion, and other volatility management tools. Now, I just want to finally finish on, could a vaccine hurt the market? And don't get me wrong, we do believe a vaccine is coming. I think that's consensus out there, which is, I think, pretty accurate. I don't think it's off, it's wrong. And, the question, of course, comes down to the efficacy. But, well, a vaccine would be really good for us humans. I think there is a risk in the market. And if you just follow the large logic here, sort of, the pandemic was very negative for economic growth. It pushed interest rates lower, and then it induced a lot of government stimulus. Now, the vaccine will probably reverse most of those trends. It'll actually be better for economic growth. We'll see higher interest rates, and we'll see the removal of stimulus. Now, the problem is the pandemic really helped growth stocks. It really helped growth stocks, because obviously changing behaviors, people sitting at home relied on technology more, streaming more. Also, with low interest rates, it made the discounting of future cash flow that for growth stocks is further out the value stocks. It made discounting that back to today more valuable. So it essentially just helps the valuation of growth stocks. It also encouraged spending on durables, which we mentioned, binge watching, domestic travel. Vaccine, probably better for value stocks. They're more economically sensitive. Again, would have better economic growth, services, doing more things, traveling further than just Banff, maybe to Tuscany. Nonetheless, vaccine reverses many of the trends that have been driving this market for the past 6 months. And the problem is that the top 5 names, which are largely all technology, or related technology, it's Apple, it's Amazon, it's Alphabet, which is Google, it's Facebook, and it's Microsoft. And those 5 names carry a weight of over 20% in the S&P 500. It's never been this high. This is a very concentrated, narrow market. And don't get me wrong, they're all great companies, otherwise they wouldn't be up there. But we've heard about great companies before. And the fact is, this is a very concentrated market, and slight changes in behaviors can cause those valuations in those companies, which are elevated as well, to come down pretty quickly. And given their weight, that would have a material impact on the index level of the S&P 500. And, I think that's fair to say. You can also see this in sort of the spread between value and growth. And, this is, so growth and value, growth stocks, obviously, they're just growing their earnings a little faster than everybody else. Value stocks tend to be cheaper, growing earnings typically slower, so otherwise they'd be growth stocks, but their valuations are much lower. And what we're seeing here is that the spread in valuations between growth and value has gone to unprecedented levels. It's, 13 multiple points between growth and value today. It has never been that high. And I think that's certainly area of concern, but also an area of potential opportunity. There's a lot of pockets of value out there. Today might not be the time, but the closer we get to a vaccine, those pockets of value will probably start catching more of a bid and getting more investor attention. And again, I think that's one of the areas that people should be focusing on. Maybe taking some profits from some of these higher flying growth names and moving to be a little bit more broadly based and a little bit tilted a bit more towards value. Well, thank you very much for listening. If you have any questions, feel free to contact your Richardson GMP advisor or any member of the team. Thanks, and have a good day.